Thank you everyone for visiting or attending this webinar hosted by FX Street. Today we're going to talk about something that's really occupying me a lot at the moment. Well, actually, it has done. If you've been following along with these webinars that I do for FX Street, I've been doing them for a long time, maybe 5 or 6 years or so. And even back then, I was talking a lot about supply and demand and whatnot. And I think as well back then I was talking about automating the process uh, of trading supply and demand. And the reason I want to do that is because I perceive it as being probably the ultimate challenge. You know, when you have something that's as complicated, complex as a market, and then being able to make sense of it programmatically, this really excites me. So this is something that kind of gets me up early in the morning and keeps me up late at night, while I ponder how on earth this market works and how it can be automated. But if you saw some of the first videos or webinars, maybe let's say 6 years ago, 5-6 years ago, excuse me, I think I think the one of the algo traders, or the algo trader that I'm going to talk a little bit about today, was still the tool that I use to find the most optimal configuration parameters for the supply and demand software that I wrote. And it's evolved into a standalone tool, and it's really exciting, and I really feel that I'm very, very close to having something that is profitable, and not requiring too much intervention. This is the dream, at least. This is something that I'm really trying to move towards, and so this is the goal for me. But what I want to talk about, just a few things, but one of the main things is, I mean, how can we qualify these areas of supply and demand? We all know what they are, more or less, and if you don't, we'll just do a quick review. That's just so that we're all on the same page. But essentially, I mean, you have an area of perceived value, okay? And so this perceived value, this is just a period of time where buyers and traders were happy transacting with one another. And all of a sudden, an imbalance occurs, okay? And so you ask yourself the question, well, why did this imbalance happen? Why did prices go higher? And that's the simple answer is that demand consumed the available supply. When I say the available supply, I don't necessarily mean that there were more buyers than sellers. It means that the quantity of the asset that I wanted to buy was less than the amount that I was looking to buy. And so if you consider like an order book, let's just draw that very quickly, where you have the top of the book, the bottom of the book, and then you have bids. Okay, so buy prices, they are, let's say here, people are happy to buy at low prices, and the interest in buying maybe dries up a little bit as you get to the top of the book, because this is a cheap price, and this is a high price. Okay, and so yeah, we want to buy at cheap prices. We don't really want to buy at high price. But what are we happy to do at high prices? We're happy to sell. Okay, so we want to sell, preferably up here, and we don't really want to sell if we're getting a pretty bad price for it. And so essentially, supply and demand is identifying this narrative, which is essentially the struggle between available liquidity and buyers and sellers, and trying to capitalize on that. Okay, and it sounds a little bit abstract, and maybe it is a little bit, but essentially we're looking to identify these price structures that are telling us a story, of which essentially is like the underlying narrative of the struggle between buying and selling the assets that are available. Okay, and it can be quite difficult. It's not impossible, but what we want to do is we want to teach ourselves to actually, let me remove this thing. I think I'm just playing with this standard deviation thing just for fun. Let's remove that. We don't need that. And so what we want to do is we want to train ourselves to see where this story is being told. And you can see it relatively easy. And my whole goal for writing the software was to help me understand, rather to help me find these areas. Because initially, when I started off writing software for trading, it goes back, I mean, a long time, and back to 2011. And so I didn't know a whole lot of that window of figuring out is it's a closing window because it changes all the time. So you always have to kind of keep your eye on the ball. You always have to focus, and you always have to maintain this student mentality so that you can so that you allow yourself to continue to learn. And so the software I used to help me kind of find these areas of supply and demand. And let me move this out of the way. Boom. And what it does is it shows me where this dialogue between the buyers and the sellers is going on. Okay. And so it's telling me that when price is here and when it leaves, when it comes back, it's probably going to go higher. And it did. I mean, price left and we came back. We didn't even move through this area of demand. I mean, and this area held for a lot of attempts to move through it. And why is that? Well, that is because that the market had more available um, um, demand for this asset than supply. Okay, and when you have more demand for an asset than you have supply of it, well, this is naturally going to cause the prices to increase. Okay, and so we have a wall here, what appears to be some kind of a wall, like a price wall, which is holding price, like a floor or support. Okay, and so prices comes down to that area and then they move away, which is totally expected behavior. Okay, we had another one here. Prices went up, prices came down to it and moved away. Okay, we had this one here. Prices left, prices came up to it, and then price moved away. We had a lovely reaction off this one here. Okay, and I'm toying with some different configurations, and so this one is a very strict configuration, and so most of these areas are going to work. Um, but but it requires that you understand what is going on. And so essentially, um, the sound was missing. Okay, and now it's back. Okay, good. Yeah, just give me a shout, editor, and I will see what I can do. Okay, so what we want to do is we want to look for these. We want to look for these little areas here. And the software found this one, it found this one, it found this one, it found this one down here. But there are also others it's not finding because it's quite difficult to quantify. Obviously, I think machine learning could be used to do this, but I'm a little bit nervous about applying machine learning to this just yet. I will certainly try to do this in the not so distant future. But if it's fed bad patterns, if it's looking at bad patterns, then I think the result is going to be less positive, which is what I want to try to avoid. And so I'd rather see fewer good areas that I know are good and trade those than many areas that are questionable. Okay, and so what we have to do, some of the criteria that I have when I'm looking at areas of supply and demand is, and I have a checklist. As a matter of fact, I'm going to put this on. I made this here. Let me see if I can share. Share. Okay, can you see this where it says supply and demand? I don't know if you can. Just give me a thumbs up or a thumb up. No, you can't. Bugger. Share, share, share. Okay, here. Okay, here it is. I'm going to share that. Now you should be able to see it. Okay. Okay, so here, I mean, we have something called a quality, go away, a quality checklist. And a quality checklist it's essentially telling us something about the anatomy of these areas that seem to work over time. Okay, they're not all going to work all the time, but you want some that are going to work reasonably well a fair bit of the time because you can't get all of them. Okay, and there are a few different parameters that you can pay attention to. And these parameters will help you identify these areas. Okay, and one of them, which is a big one, is departure. Okay, you guys should be able to see now on this side, the supply and demand, and then this side, my chart. Is that correct? Just give me like a yes. Yes, cool. All right. And so what we want to do, what we want to look at here is we want to see something about a departure. What does that even mean? Well, the departure shows us that we have an imbalance, and an imbalance is very important. And if we go back to what we spoke about just a second ago, it means that we have um, more supply than we have demand. And when you have more supply of an asset than you have people who are willing to buy it, what happens? Well, the price goes down. Okay, but it can also be something different where you have more sellers than there is available bullish liquidity. So you could have, for example, your like via the interbank market, maybe there are less people willing to buy on the sell side of the market than there is to sell on the sell side of the market, if that makes sense. And when that happens, what happens is the selling orders simply eat up or consume the available liquidity, okay, causing price runs to occur like this one here. Okay, and so when you have a big push down like that, it can mean exactly that. There's less liquidity available below price to satisfy the people who are looking to sell, or it can be that that there's too much supply and there are no buyers. Okay, and this will cause prices to sell. So there are a few different scenarios that would result in price to create a price structure like this. Okay, and so this is just telling us that we have a lot of selling here, potentially a lot of selling here. We don't know for sure. It could just be that there's no buying, which would also cause prices to go down. Okay, but prices went away. They moved away from this area here. And this area here, this is a perceived period of agreement. Okay, people were happy transacting with each other. Okay, people are happy buying and selling to each other. And all of a sudden, what happened? Boom, prices went down. Well, that means, wow, there's a new perceived value for, what is this, the Australian dollar, Singapore dollar. And so people are happy to trade at lower prices. Okay, and this happens all the time. And anything can affect this. It can be economic data releases. Let's say that the Australian dollar, they decide to cut interest rates, or they have worse than expected job data, workforce data, or like PPI is worse than expected. This affects the economy, and the economy, in turn, the strength of an economy is reflected in the value of its currency. Okay, so you can see the health of an economy is reflected in the value of its currency. Okay, and so when a price moves like that, I mean, as I mentioned, there are a plethora of reasons that it went down, but we know that it went down. Okay, and so if price is up here, you don't have to guess. Okay, is price going to go up or down? I'm going to buy, or maybe I'm going to sell. You don't have to do any of those things. You just wait. Okay, and if price goes down, well, then you know that the Australian dollar is depreciating in value relative to the Singapore dollar. What does that mean? That means you want to sell the Australian dollar and buy Singapore dollars. Okay, so when price leaves like this, okay, you're told, rather you should have the logic that that you want to sell, okay, for the medium term, short to medium term, because these economic data releases, they're changing all the time, intra-week, and this will cause like intra-week volatility, both prices going higher and prices going lower. Okay, we don't need a crystal ball that's going to tell us what's going to happen over the next year. We just need to see this intraday volatility that we can see here. Okay, and so the whole idea is that if prices move away like that, well, then we have a merit to selling. We sold here. What happens? Well, we can expect that prices, when it comes up to this area roughly, that we're going to move away. Okay, this is essentially what happened. Okay, another thing is we want to see maybe prices trade away and then stay away for a while before they come back. Okay, so this is what this one is: accumulate or distribute away from the area of demand or supply. Okay, and so prices did. They came down. We stayed away. We formed this black space between the leg down. Okay, and here prices traded away. That's good. That tells us that, I mean, price didn't go away and then snap back. Okay, so that tells us that the price is heavy. Okay, and we can see gaps. What does a gap mean? A gap is a very important one because gaps are telling us about the state of liquidity. So if we go back to our order book and we have big liquidity at the bottom, and prices here. If price is here and it goes down and it gaps down, let's say prices, this is the market price. If price gaps down to this area here, that means that there are no bids. There's no one's looking to buy here. And so price has to go down. It won't stop falling until it finds bids, because there's what's known as like a liquidity void or a price inefficiency. And so prices will just slip through that. Okay, so this is essentially what a gap is. Okay, gap is a price window that is void of opposing side of the market liquidity. Okay, so this shows us a lot of strength. So when prices gap like that, it means, wow, I mean, no one's looking to buy. Okay, so when you have these, prices close here, and then all of a sudden the next bar, it gaps down to here, and then it kind of moves up. It'll typically come up and close that gap before it figures out what it's going to do. I mean, that's telling us something about the state of liquidity for that asset. So this is super important. Okay, then you have something about the structure of these areas of supply or demand, accumulation, distribution. This is supply, okay, or distribution. Distribution in that liquidity is being distributed to to the buy side of the market, which is us. Okay, and we won't go into detail about that, but it's just telling us something about the structure of this here. Okay, and essentially the hypothesis is that the more time price spends in an area, the lower the liquidity available at that area. And as you guys have all seen, I talk about pancakes a lot, where you have like a plate of pancakes, and this could be a plate of pancakes here. Let's say we have pancakes here. Okay, like so. And as prices go up and down, and move up and down and into that area, each pancake represents some kind of like a pocket of liquidity. Okay, and each time it goes up into it and it consumes some of the liquidity, well, then it's the equivalent of, if you consider like a pancake metaphor of somebody taking half a pancake. Okay, and so if someone else comes later and they want to take their pancake, there's only half a pancake left. So they say, oh, bugger, I'll take that half, but I'm still hungry, so I'm going to take a little bit more. And so they'll have to find another one, which essentially pushes prices higher. Okay, and so if we're talking about what do you call it, bearish price movement. So when prices go up, we consume liquidity. Okay, and so liquidity above price goes down because these price movements into it are consuming it. Okay, and we know that it was consumed because, I mean, we had a reaction when prices move away. Boom. Why does it turn here? Because it met an opposing order block that was bigger. Prices go up, we turn around, we consume something here, but down here, this order block was bigger. So let's say we had 200 here. I'm actually, this is a bit of a random walk of a webinar. I'm not even touching on this automation stuff, but I promise to get back to it. I just want to touch on this because it's both fascinating and quite important to understand. Okay, so let's say that someone sold up here for 50,000. It came down to here, and we dumped that 50,000 unit order into a pool of liquidity where there's 200,000 available. I mean, what happens? Well, it's reduced to 150, but it doesn't budge at all because we still have 150 at that price point. Okay, and so prices will go higher. This is the thick side of the market. This is the fifth. Oops, what happened there? That was the thin side of the market. And so essentially what happens then is, I mean, price moves in the direction of the thinnest liquidity. Okay, and these price movements like this are telling us essentially what side of the market is the thinnest. And I've also spoke at length historically, have a drink of my tea, about using currency strength. And the beauty of currency strength is that it shows you exactly what side of the market is illiquid and what side of the market is illiquid. And what do? You trade in the direction of the thinnest liquidity. So if you have for example, let's say this is Australian dollar. This Australian dollar on a squiggly here. The Australian dollar line goes, come on, goes something like that. Okay, it's going up. And the Singapore dollar is going up faster. I mean, what's going to happen? What will happen? Chuck an answer in the chat there, if that makes sense. What's going to happen to the Australian dollar, Singapore dollar, if the Australian dollar is increasing in value slower than the Singapore dollar? Well, it's going to, the price of the Australian dollar, Singapore dollar currency cross is going to go down because we have relative currency strength between these two. Okay, so prices will naturally move in the direction of the strongest currency and away from the weakest currency. Okay, this is very, very common, and this is just another tool that you can use, and you can combine currency strength with supply and demand. Okay, and I also have an algo that does something like that. It's quite complicated, but you can do that as well. Okay, and so what we want to do is we want to find a way to try and automate this. Okay, so we're looking, excuse me, we're looking at these things. We're using the rules that we've defined to help us, excuse me, to help us quantify something. And that something is, I mean, it's an imbalance in supply and demand. Okay, here we have an imbalance of supply and demand. Here we have another one. Here, one. And what happens when price comes down to these areas? Let me zoom in a little bit, it's not very clear. Okay, so we had this one here. Price left. Price came down to that box. This box was drawn when this dot was printed. So it was open. This box was drawn when this candle printed, and then price, it fed into this area here, and then it held. The prices moved away from that area. Why? Because there's a price imbalance at this area here, and we know that because the algo essentially found that. And all the algo is doing, I mean, it's looking at this stuff here, and it's putting it in a rule set, and it's running the data from the broker through this algo, and it's saying, yep, great, super, perfect, I love you, I'll take this one, good. And if we have enough check marks, essentially, it says, okay, super, then we're going to buy here because we can tick all the boxes. And when we can tick all the boxes, that means that we have a trade or we have an edge. That's all you need. You just need an edge. There's no trade. There's just an edge. You say, okay, we have an edge. Then there's another part of the algo that says, okay, we have an edge. Great. And then it looks at sensible places at which to place this trade. We have the edge, and now it knows where it's going to look to take the trade, and then it chucks the order in the market, and then you're done essentially. Okay, and so if I look at, I'm just going to show you very quickly. Guys okay, this should work fine. I'm just gonna run this very quickly just to show you guys what it might look like. Let me look at the configuration quick. Okay, before I do that, I just want to say that, I mean, this is the project that I've been working on for a really long time, and I've talked about it many times in FX Street. And this is essentially like a little piece of software that runs through the checkboxes. It finds stuff that makes sense, and when it does, it makes an assumption about an area where prices are very likely to move into. Okay, super. See you later, Anis. Thanks for being here. Anis is picking up kids from school or kindergarten. And so what it's doing is it's paying attention to this rule set, and then it's getting in at the place the algo thinks is a good idea. And so if I just switch this on just to show you guys what's going on, looks like this. This is like the result of it. But here we have, we're looking at several different things. But what I want it to do is I want it to scan all of the assets in the market watch. So that means all of these symbols in here. Okay, so we've got what do we have? Palladium, we have gold, we have silver, we have a bunch of stuff. We have some, we have crude and whatnot, and we have a bunch of currency crosses here. So it's only looking in the ones that we put in here, that we allow to be in here. Okay, and then it's looking at the rule set. We have the risk. We have our loss mitigation, which tells us that, you know, if we lose more than 2% a day, then we shut down, we wait for the next day. If we go beyond 5% a week, then we stop trading for that week. If we go beyond 10% a month, then we stop trading for that month. So there's, I mean, 25% of the code of this this algo trader is risk mitigation. It's simply, it's all the time looking for reasons not to take a trade. Okay, this is super important, and this is, I mean, we have times of day. You know, we have risk exposure to currencies. How many trades per currency pair? One. How many trades per currency? So it'll only allow exposure to four on. It'll only allow exposure on 4 positions to one currency pair. So you can have, that wasn't very well explained, but it can essentially mean that we can have a euro dollar trade, a dollar yen trade, a pound dollar, and a Kiwi dollar. And then that's 4 where the American dollar is a part of the equation. So if it finds another one, which can be, I don't know, the Singapore dollar, American dollar, it won't do that because those 4 slots have been filled already. Okay, and so what we do, just flick it on, and I'm just going to let it run. I'll put it on the 4-hour like those. And then we're just going to look at those trades individually and kind of see what they look like. And it'll take, I think it starts running after, okay, I'll put it on after 13 seconds. Why 13? I like the number 13, I like Fibonacci numbers. So now we'll run and it'll spin. You can see it here in the experts. And eventually it'll start spinning. There you go. So it ran through a bunch of currency pairs. Just going to switch it off. What did it do? Did it open one? I think it did. Yeah, it opened a trade on, let's have a look what it was. On this one. Oh, that's tough to see. Aussie dollar, American dollar. Saw this, it says, yep, we like this one here. Okay. But looking at that now, that would have been an amazing trade, but it didn't come to the entry. What happened instead is, let me turn the boxing off quickly because it's in the way. False, like that. So what it did, it came to this little price nodule almost. So we draw a line from the high here to here. It almost came back, didn't it? It almost came back to this one. Okay, and so the algo actually has a rule built into it that stops it from trading. It stops it from taking positions where price has already rebalanced this price inefficiency. Because if price leaves, then it comes back once, and then it comes back again. The likelihood of it leaving the area again is less than the first one. So we only want the first test. Okay, so what it's telling us here, this little line and stuff here is telling us, okay, this is the area of demand. This is the previous high that prices were able to trade beyond that qualified this area of demand. And as a result, we want to buy there. And prices have not been back to this high here. They actually came back to this one, as you can see. Okay, so they tested this one once, twice, and then they left. Okay. So what we can do as well is we can say, well, we want areas to be qualified with more significant swings. So we can do that. We can go here. We can say, where are we? It's further down here. So opposing swing, let's put 5 here. So now it's going to look, I'm going to change this one to 0, and then we'll flick it on once more. Let me kill this one here, and then we'll just flick it on. We'll let it run. Okay, so what it's looking for now, it's looking for price to move beyond even more significant swings. So it'll probably put this line over here. That didn't. That's good enough, apparently. Did I do it right? Okay, I know why I did that, because I was fiddling today. Okay, so if we look at that one, and we look at the other ones as well, let's look at another one. So this one here, so it found this area here, and it said because price moved beyond this high here, you see, like we had an area, a micro area of supply here that moved price beyond this. Okay, this one was qualified by moving beyond this. Prices went through it. We tested the backside of that once. We tested twice, and then this is the origin of the move that moved prices beyond this little micro supply and this high, which is essentially the attempt to move through this supply on the way out. Okay, which is why I qualified this one here. Okay, and we take another one, we'll look at the next one. This is just a similar position. These are going to be the same. They're both Kiwi trades. You can see they almost look like each other. And I like this one better. It's just much clearer. This is just a really beautiful, clear breakaway here where everything's lined up. Look at this. It's beautifully lined up along here, here, here. And this is where price is left from. And this is a huge departure. And so when this candle closes, it puts this box on here and says, good, we have a level, we have an area. This is where we want to be. Okay, so this is what it does. And so what we can do as well is we can say, well, let's go. Let me put the defaults on. False. Let's go to another setting I want to talk to you about. This one here, the last bar. What does that mean? Well, the last bar means, actually, it means that we only want to look at the past 20 candles. And this is important because if you consider, it's not only important, but it's really, rather, the reason it's important is because if you focus on the most recent price structure, then the data, the sentiment, the state of liquidity in that moment, in that session, is still lingering in the price. Okay, it's still lingering in the price 20 periods back. Boom, if we go out like that, let me do this. Oops, a cup of tea's in the way. It's still lingering in here. Okay, and so when you force it to focus on bleeding edge price, then you're telling it to pay attention to the moves that have just happened. Okay, and so if prices go like that, it's going to look for the areas of demand that cause prices to move beyond there, and it's going to look for a correction on this price, which is in the vicinity of current price, bleeding edge price. And the smaller that number, the more strict it will get. It'll look further and further towards bleeding edge price. Okay, you don't have to do that, but I like that. I find that I find if you're, okay, just to make it super clear exactly what it is I mean. We zoom out, we're going to see some other areas pop up. Let's go to a different symbol where we have more. Doesn't matter what it is, just something else. Okay, so we have, we have this one here. This one was formed and price did not come back to it. Okay, so, I mean, the algo in that configuration would not have traded that. Why? Because 20 periods is maybe around here and price didn't come back. So it wouldn't even look at that anymore. It'll keep moving that window and it'll say, okay, wait, here we have 120, cool. Sell here. So it would have sold here or here. And then 2020, it would have sold here. Here, it would have sold here. Okay, and so this one here, it would have sold right there. Okay, and so it's focusing on bleeding edge price because this is where, for example, if you have like a New York session or a London session and prices they're really, really running during that session, it'll focus on the momentum for that session instead of looking at the momentum of another session, 6 days ago or 14 days ago. Okay, because things could have changed. There could have been changes in financial data, economic data since this high, this lovely area of supply was formed. Okay, it did work once, and now it's working a second time. We'll probably move lower from here. But things have obviously changed since here. Okay, so this is something you have to pay attention to. When you look at this one here, this one just popped up. We move this, qualified by, test, boom, test, boom. Okay, and so essentially what we want to do is we want to try and force the algo to focus on the most important data, which is now. Okay. Okay, good. Is everyone with me? Does anyone have any questions? I'm kind of just rambling along. How long have we been going for? 39 minutes. We can keep going a little bit more. And then if you guys have any questions, you can just drop them in there. And then I can get to those when I'm finished here. Okay. And so this is essentially what we're looking for. And so, I mean, so if we want to automate supply and demand, or you want to automate any system, I mean, you have to have a hypothesis about something, and a hypothesis can stem from any number of things. You can have an idea, so you have an idea about something, and you test your idea, or you can look at the data first, and you can allow the data to help you formulate an idea. Okay, and supply and demand for me it's a data-driven strategy where the questions that emerged came as a result of looking at the data being the price feed that we have here, that I have here. Okay, and so I looked at this and I said, prices, when prices leave an area like that, if they come back to them within 20 periods, price almost always reacts, and it does. Here, price, even in this little tiny one, price tested, went up, and then we went down. You see the red candle in there. We got a 1-to-1 in there. Here, we didn't come back to it. Here, we came down to it. Winner, 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 loser. And so, and so you can see that. I mean, you have to have something. You have to start ask really good questions. Okay, and so you can look at a pattern that's happening over and over again. And price inefficiencies are a really good one because they're happening all the time. Okay, and so this is just something that's really good to look at. Okay, when price moves quickly away from an area, I mean, that's telling you that you need to pay attention, or at least it told me that I had to pay attention. That's why I went after it. Okay, and so it allows you to formulate something like this. And with the advent of technologies like ChatGMT, you can go on to ChatGPT and say, and you can ask it questions about, for example, liquidity. And if there's a concept that you want to know something about, like, for example, last look, you can ask ChatGPT, tell me what last look is. And it'll tell you what last look is. Or if you want, you can say, like, tell me how price behaves in a forex market or a stock market when liquidity on the sell side is thin, and it'll tell you what's going on. And so, I mean, these tools are amazing because they allow you to get answers really, really quick, and they're better than search engines. Google's kind of useless because you have to know what to ask, but something like ChatGPT is a really good solution because it enables you to ask questions. What happens to price when liquidity dries up? And then it'll tell you something like, when liquidity dries up, then the ask bid spread widens, which causes increased volatility and stuff like that. And you say, oh, what is volatility? And you're actually learning a lot by asking these questions. And so on the road towards creating an algo trader like this one I've written, you learn a lot because you're forced to ask questions. Okay, and so if you're looking at the data and you're noticing patterns, why is it when we form a high and then price runs up one more time, slightly higher, and maybe has another go, why is it the price thereafter often moves very, very quickly? And you can see these all the time. So this is just another data-driven observation that would encourage you to ask questions that would result in you being able to formulate some kind of a hypothesis regarding a way that you could automate this strategy. Okay, so anyway, it's super fascinating. Well, if you're into that kind of thing, and I start talking about trading, my wife's eyes gloss over. So let's have a look just at another example. I've been doing a lot of development on the algos today, so things aren't working like they smooth as they normally would. But let's just put it on there. Let's put it on the hourly chart and we'll let it run on the hourly chart and see what happens. So yeah, and so it'll start spinning in a second. But before we get to that, I just want to point out this one here. You can see here that this area here, price left, then we came down, and we had this area of demand, and price has not come into it, but the algo said it's already been tested, which means, what does that mean? It means prices will probably move through it. And the reason it does that is because, let me draw, is because that this was the area that qualified the area, and prices move through this area. So this is telling us that this has already been rebalanced, essentially, because you have, I mean, this is just like we have a price structure that looks like this, where price goes up, goes down, it moves up really quickly, and then it comes down. Okay, so when price comes down, I mean, this is the reference point that price will often, let me change that. Doop, doop, doop. This is the reference point that price will often go to. It'll come down and it'll bounce. Or if we have a continued liquidity void in here, like we do, in here you can see, oh, it's not very good, but you can see below this line, which is which marks the top of this swing just here, we have a price inefficiency. Okay, so that means that there is limited bullish liquidity in there because price moved through it quite quickly. Okay, so when price moves through an area like that, it means that there's, actually, that's not even correct. It means that there's a potential that prices could easily come straight back to the origin of the move, which is this. Okay, in contrast to something like this, where if price goes up, we go down, we move up efficiently, we move sideways efficiently, we move up to this high, we move away to these highs, and from here we move through, then price will probably react here at the top. Why? Because all of this has already been dealt with. There's no price inefficiency in here. But here we have a lot of price inefficiency still. So prices will easier move back to the origin of that, which is where this box is. Okay. All right. So, so this is essentially where we're at. If we have a look at a couple of these orders, these are hourly orders now. So it likes this. It likes this a lot, and this is a clear box. And this is if we go back to the list that we had just a second ago on my mind map. I love this software. It's called Xmind. If you guys are wondering, it's an incredible piece of software and it enables you to create these really cool, these amazing mind maps, and I love it. I absolutely love it. I do all my brainstorming in this software, and it's highly recommendable. Anyway, but what this is, I mean, we have this little area here. We have a price inefficiency, and you can see that the high of this is about where the base of this area is here. So this is a very interesting place. Okay, so prices will probably come down here, maybe even feed into here, which is also highly likely, and move away from there. What we want to see when price approaches an area, we want to see inefficient runs into a highly liquid price nodule. Okay, and this is exactly what we want to see. I would feel more comfortable buying here if price continues to move inefficiently down to it than I would if price did this. I'd feel more comfortable buying. I would feel less comfortable buying now in contrast to this. And why is that? I mean, why is it? That's almost counterintuitive. I mean, and you think like, I mean, doesn't this show strength? And the answer is no, it doesn't. Because the further price has to move, to get to an area of structure like this, the weaker it is. So when price is here, it's super weak. And on the 1 minute chart, if you looked at that, I mean, price would, you have the area here, price would come down to it. And on the 1 minute chart, it would go like that and it would snap back and it would go like that again. And it would snap back. And it does this because liquidity is so thin there that price has to, I mean, price has to travel very, very far to find it. And so you can say that um, volatility is a function of available liquidity, which is what my dear friend and mentor Chris Laurie always preached to me. He said, volatility is a function of available liquidity. Okay. And so if prices are jumping around like crazy, like they will be once they come down here, it's telling you something about the state of liquidity as price moves into a structure like this one here, a slightly more liquid structure than this. This is an illiquid move. This is weak. This is strong. Okay. And so we can expect prices to, let me remove this, to move down into this area like so, and then snap back. Okay. It's not going to go here and go to the moon, but it gives you the opportunity to, you know, to get out at an obvious logical place, which could be maybe the backside of this little price structure down here. Sorry, up here. Okay. All right, good. I've been rambling now for 49 minutes, so I'm not going to say any more unless you guys have any questions. Anyone has any questions that they want to talk about? Hey, Rajesh and Paul, John, Don, AM. Does this stuff make sense? Is it interesting? Is it boring? Is it confusing? Is it trivial? Is it easy? I really like a bit of feedback to hear what you guys think. Super. Okay, very, very good. I'm very pleased to hear that, Don. Thank you. Because it can be quite difficult to get your head around it, but it's actually not that it's not that difficult once you kind of start to understand it. Essentially, you just have to know that price moves in a certain way for a reason. Price has to travel very, very far when available liquidity is limited. Okay, it has to move far to get to it, which causes a lot of volatility. You were late for the cinema. Oh, super. Yo, this is recorded. So you'll be able to find that in the record in the archives, Don. Amrak is asking, what time works the best? Well, that's a difficult one, but it's not. I mean, for me, I'd say 4 hour. I love the 4 hour chart. So my time frame that I prefer to trade on is the 4 hour chart, and I like that because it's fast enough to get a lot of movement, but it's slow enough to um, to show areas where we have like significant amounts of liquidity. Okay, now it's doing. Let's have a look what it's thinking here. So it wants to buy down there. It says, yes, I want to buy down here. Yeah, I mean, that looks like a reasonable area. I like that area here. I like this one here. Okay. So I would definitely say that the 4 hour is a really good one. The 1 hour is great. The half an hour is great as well. It requires a little bit more work. The 1 minute, I'm not very skilled at the 1 minute, so I try to stay away from that. Some people are really good at it, but I'm just not good. I like to watch the 1 minute chart, and sometimes I'll click in on the 1 minute chart, but all my decisions are made on a different time frame. It's just for timing sometimes. If I'm getting in at like market, which I'll sometimes do if, for example, if price moves up to here and I can see it's here, I don't stress and just jump in. I'll go to the 1 minute chart or the 5 minute and I just watch and see how price reacts when it gets here. If we have a nice inefficient run up into here, we start to see prices snapping back like so on the 1 minute chart or the 5 minute. And then you'll see prices like create some kind of a structure, and then the structure will start to break down, which can happen in anywhere from 3 to, I don't know, 10 minutes. If you watch it for 10 minutes, you'll often see what happens. Sometimes prices will run a little bit higher and seek liquidity to drive prices lower. Other times, if there's a lot of selling pressure here, prices just spike up and then go in the opposite direction immediately. And then I rarely get those trades unless I have a pending limit. Yeah, but so to answer your question, the 4 hour, the daily, the weekly are amazing time frames. And so, yes. I was asking, is it easy to see in ranging markets, but how do you work in a trending market? Well, it works pretty much in the same way. Typically, you will see, this is just a really good example here, if we look at this is a trending market. Okay, that wasn't very good. Let me try and get it closer to the structure. Where's the thingy here? Okay, here. So if it's like that, so this is pretty much where we are. So this is a ranging market, and you don't know it's ranging until it's ranged for a while. You know, price will move sideways for a little bit, but here you could see, I mean, here prices are ranging here, and prices are ranging here, and here, and here, and here. So price is ranging all the time. It's ranging a lot more than it's not ranging. Okay, but you have these little areas where you have ranges value, the value is increasing. We kind of had like a step formation. Like people are happy paying more and more expensive prices for what is that, gold? I can't see, it's too small. Okay, and then we form this period here of perceived value, and then prices start to break down. Okay, and so in a situation like that, I mean, we can see that. I mean, you would trade these obviously differently. I mean, I like this area up here because we have an extended period of perceived value. You know, prices were happy moving sideways, and then the departure from that area, excuse me, occurs from here. Okay, we have this. You know, we have this little price structure here, and then prices move away, taking us below this perceived historical value. Okay, and so prices came back up into this area here. I would be keen to look to sell, and I would be looking at opposing market structure to get out of the trade, depending on what price looks like as it moves up to this area here. I don't know if that answered your question. Yes, let's wrap up. Adinda FX Street is going to pull us offline. I think we've covered a lot of material. So if you guys want to, if you have questions, let me put my email in here. Hey, thank you so much, Adinda. Pipnotic. You can shoot me an email. There's my email address. I have a Discord. You can jump in for free. We've got a lot of really cool people in there, and yeah, I'd be happy to speak with any of you. But hope it's interesting. Thank you so much, FX Street, for hosting this once again, and we'll see you again next month.